Hi, I'm Ben Reppond. Today is June 6, 2023. Welcome to my YouTube broadcast. The market keeps dealing us a new look almost every week. So today, as of last Friday, actually last Thursday and Friday, but especially Friday, the market showed strength. What was interesting about this is that it showed broad strength. It was across all sectors, including cyclicals, whereas before it had been primarily in the tech sector, and frankly, the strength of the market was in about 8 stocks, and the rest of the market was weak. But Friday showed us a different look, and that was based on the jobs report. So I'm going to give you some clips. I'm going to kind of review the market, and then I'm going to get into real estate and what's going on with real estate. I'll begin with Jans Hatzius, head of global research for Goldman Sachs. And he explains this about what's going on with the market from his perspective as of last Friday. Take a listen.
Jobs number, of course, today, 29 straight months of strong growth, ahead of consensus for 14 straight months. Joining us at Post 9 this morning, Goldman Sachs chief economist, head of global research, Jans Hatzius. Great to have you back, Jan.
Wonderful to be here.
Here we are again, sort of trying to decide survey, household establishment. Is there confusion this month or not? Is the direction pretty clear?
It's a bit noisier than normal, I would say, because you had a lot of strength in the establishment survey and a big drop in household employment, and also some weakness in the work week. But if you cut through the noise, I would say it's a strong report. It shows that the labor market continues to make progress. It suggests that we're still getting the benefit of increases in the labor force, and it shows that the economy is currently at least nowhere close to recession.
Does that mean you're able to look past the jump in the unemployment rate?
I think you can, because the jump in the unemployment rate was really driven by a decline in self-employment. And yeah, I do think that this can be quite noisy. If you look at the household survey adjusted to the definitions of the establishment survey, you actually got a healthy increase in household employment. So overall, I would say it's a strong report and confirms that the labor market remains very solid.
Next, I'll play a clip from Jeff DeGraff from Renaissance. He has been saying for many months, even into last year, that the market is going higher, even when the market in the last part of last year was still struggling. He said it's going higher, and there were segments that were. So CNBC went back and interviewed him, kind of taking a look at the last 9 months and what's the outlook for the market. So he's more of an optimist, looking at the fact that the market's going higher, and he explains why.
It's good to see you. I mean, you've been, in the camp, sticking to the idea that this market is in an uptrend since October. It's gotten a little ragged. Parts of the market have, on the verge of breaking down. But what's your assessment right now of this push to a new, 9-month high?
Yeah, look, I'm still optimistic. I think there are better things happening than people, or particularly the bears, are giving it credit for. One of the big ones for us, our credit spreads have really kind of led the way here. They've stalled out a little bit, but certainly not anything like you'd expect given the concerns around banking and some of these concerns around recession. And I think that's kind of the bears' biggest foil here is it's hard to explain what's happening to the credit markets. They've been very, very resilient, and usually the equity markets are going to be an offshoot to that. And I think that's exactly what you're seeing.
Next, Scott Wapner from CNBC interviews Jim Lebenthal, and he talks about why he believes that stocks are going higher, and that based on what was going on last week, and especially on Friday when there was a broad support for different broad sectors as opposed to just the focus on the tech sector. And that did occur on Friday. It was a kind of a across-the-board rally. And so before that, I mean, really a lot this year has been mostly on the tech sector. Of course, AI entered the picture recently, and the rest of the market has been struggling. But so this kind of gives a different look, and Jim Lebenthal explains his take on it. Take a listen.
Was this the perfect jobs report and perfect scenario for somebody like you, Jim Lebenthal?
This was pretty darn good. This was
Perfect
pretty
for me
darn
too,
good.
by the way.
I'll parry with you later because there's something serious I want to say. And as much as we enjoy it, there's something serious I want to say here, which is that there is a logic to today's move. Whatever your thesis is, all right, this jobs report, to your question, Scott, is what a soft landing looks like. And I'm really getting tired of these landing things, but let's just do it for now, okay? You have job growth, but you have an amelioration of average hourly earnings. That's what you're looking for, 0.3%. Yeah, we want it to come down further. I want it to come down further.
You just raised your S&P target yesterday thinking on the idea that there's not going to be a recession. This report today lands right in your lap.
And yes, and I'm sorry I'm burying the lead. The cyclical's killing it today is the logic of which I'm speaking. By the way, part of the reason I'm not going to parry with Steve is because there's logic to what he is saying, okay? 500 basis points of Fed rate hikes should have an effect. The simple fact is they haven't yet. I mean, you look at this jobs report, you look at construction spending, you look at ISM services. Yes, there are some warts, okay? But the idea that a recession, remember at the beginning of the year, everybody said recession, 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 recession. If that were the case, you would be seeing a negative jobs report right now. You're just not. And to Steve's point, if the Fed is pausing right now, the logic of today makes sense. And further, okay, taking nothing away from tech, the prices at which these cyclicals are trading are simply ridiculously cheap. That's where you should go.
Now I'm going to shift gears away from the stock market over into real estate. So Diana Olick from CNBC gives her report on the housing market and mortgage rates. And mortgage rates this last week, and I think it was on Friday, went up above 7% and then dropped back down to 6.85. But she believes they are actually going higher. So it's a kind of a battle that's going on with the high demand for real estate and high mortgage rates, which, of course, put a headwind on that demand. And she talks about this. I think it's an interesting perspective. Take a listen to Diana Olick.
Mortgage rates have been on a roller coaster, hitting over 7% just in the last week. Diana Olick joins us now with more on what the volatile moves mean for home buyers. Diana.
Well, Melissa, mortgage rates have been on a tear in just the last few weeks, thanks to the debt ceiling and hotter than expected economic reads. And we just, of course, got another one in today's jobs report. Just since the middle of May, the average on the 30-year fix climbed from around 6.5% to over 7% last week. Then it dropped more than a quarter of a percentage point just in the last 3 days with the debt deal. We get today's read from Mortgage News Daily around midday, and given what's going on with the 10-year yield, which mortgage rates loosely follow, the rate will likely move back up again today. So what does this mean for home buyers who are trying to lock in the lowest rate, given how pricey the market still is and how competitive it is? Well, they've seen the potential monthly payment on a $400,000 mortgage swing up by over $150, then back down $50 or $60, now likely up again. That might not seem like a lot, but a lot of buyers today are right on the edge of affordability, and at higher rates, some won't even qualify over 7%. So while stronger job market is good for housing in general, right now it's translating into higher rates at the tail end of that all-important spring market. David?
And finally, I'm going to play a piece from David Faber, CNBC, interviews Glenn Kelman, CEO of Redfin, and what he gives his take on what's going on with real estate, mortgage rates, and demand. Again, interesting perspective from his point of view and Redfin's point of view. Take a listen.
Let's get more on the health of the housing market. We turn to Redfin CEO Glenn Kelman for that. Glenn, always good to have you. Inventory problems, sort of number one, is that, or inventory, lack of inventory, the number one issue right now in housing?
It's number one, number two, and number three. So not only do we not have enough new construction because of political gridlock and financing challenges, but we also don't have anyone putting their home on the market just because they have a 30-year fixed rate below 3%. So nobody wants to sell a home right now, and there's still plenty of people who want to move.
So what changes that? What will be the change agent here, so to speak?
Well, I think we're going to be on hold until rates come down. 7% rates aren't that bad historically, but it's been such a steep rate increase that many people have very low mortgage rates and very long to go on those mortgages. So they're going to hold out until rates come down a little bit. Most people couldn't buy the house that they bought 2 or 3 years ago. So it's unthinkable for them to move up. We've seen a slight uptick over the weekend in listing demand. Some people are coming out for the summer, but it's well below where we would expect to see at this point in the season.
So with all these forces, Glenn, what's happening with prices? They're clearly not coming down as fast as the Fed wanted them to.
Yes, we've been pretty pessimistic about sales volume. We think it'll be around 4.2 million units when normally you see around 5 million, but we're pretty sticky on price. Prices are going to stay fairly high. It's going to be a real affordability crisis for the millennial generation. Many people want to move, and they just can't do it because prices aren't going to come down in this housing market correction. It's the weirdest housing market correction I've ever seen.
Are they coming down faster than rent prices? Which is more affordable now, buy or rent?
Neither one is really coming down, but rents are coming down faster than home prices.
Now, I'm going to shift gears one more time back to the stock market. So this is a chart. I've shown it before. It's a chart. It's a 150-year chart going back to 1870. So it's moved into just a few inches. So what it shows is the macro cycles, the secular macro cycles of the stock market and the macro secular bear market cycles. They are marked by red, bulls are marked by blue. And so the chart has a regression line cut through the middle of the data, and then there is a regression channel that shows the top of the market and the bottom of the market. So from all the way to the bottom and all the way to the top, put inside of a channel, overlaid on top of the mean regression line. So it's interesting. I think this is interesting from a macro perspective. So don't expect things to necessarily change next week or next month based on this chart, but it does give a longer term perspective. So I put an arrow at the far right corner of this, and to show this, the pullback, the drop at the end of the chart shows what occurred in 2022. And actually the early 2023. Now keep in mind, this is the S&P 500. A lot of strength this year has been from technology. So S&P is not up as much as technology. So what it shows is two or three things. When you look at the top of the channel, the regression line at the top, in the end of 2021, it touched the highest point on that channel more than any time in the last 150 years. Now, this is put on a logarithmic chart, so keep that in mind, but that gives it more of a realistic view. On the bottom end of the channel, where is the lowest point that it touched? 1929. Or you could say probably 29, probably 1932 was the lowest point. And so you can see that that red line that goes down around 1930 probably touches in 1932. That's the bottom. The top is the end of 2021. Those are the two extremes. Everything else is somewhere in the middle. So it seems to me, it's a question, and then I'll tell you what I think. The question is, do you think this is going higher and will touch that upper end of the channel or even form a new upper end of new upper edge of the channel? Do you really think that? Well, I don't. I don't think it's going up that far. I think it is going to find a way to work its way down. It will have periods where it will go up, but we've just touched, in 150 years, we just touched the extreme on the upper end of the channel. But this shows you, no matter how far down it comes, eventually, at some point, the market has got to come down to the regression line and below the regression line, some distance below, we don't know how much, to represent the coming bear market, the long-term secular bear market. But you can see how far down it's got to come, even if it comes down a little bit below the line like it did in 2008. That's a long ways to go. So I just want to give you this perspective that at some point in the future, again, don't hear this as this month or this quarter, but at some point in the future, there is a long ways that the market has got to come to correct. And because we have been in this approximately 15-year cycle, bull market cycle, it is getting weary. It is getting to the end of a typical bull market cycle. So it says to me, if you're a buy and hold investor, you're careful about your money. I would say be cautious. We're tactical, so we make moves in the market depending on what's going on in the market. So I'm not concerned about that, but I know that most people are more buy and hold strategic. And this would be, if I were that, it would be flashing a warning sign to me. So just an FYI. The money, there's two things going on. I mean, money is coming out of the market, but at the same time, the market is going up. And it particularly marked by the last several days. But the conventional equity funds outflow, 15 billion. Conventional bond funds inflow 1.9 billion, and money market funds an inflow of 31 billion. So there is in general still a flight to safety. But yet equity risk, equities in general are still going up. Interesting. So the bulls are talking to the bear. We're very concerned about you. You need help. So it says that the bears are, for right now, just this period of time, it may go on for a while or it may not, I don't know. But for right now, the bears are retreating and the bulls are coming into focus. But there are reasons to be concerned. There's reasons to be bearish and cautious. But we're invested in the market. We're invested in the NASDAQ, and so we're going to keep doing that as long as the market tells us that's where we need to be. But some people don't do it that way. They're more allocated and buy and hold, but we're going to ride it. I mean, we want to make money. We have been making money. So this past month has been a very good month for us. And so we're going to keep doing that, but until the market tells us something different. But be careful. Thank you for watching. If you have questions or comments, leave them in the comment section below. Thank you.